Research at Citi, Markets Edition.
Welcome to Research at Citi, Markets Edition, where we break down global macro in 10 minutes or less. I am your host today, Alex Saunders, head of Quant Macro Research, and I'm joined by Giammarco Miani of our Global Macro Strategy team. Welcome to the show, Giammarco.
Thanks, Alex. Great to be here.
We're recording this podcast at 9 a.m. on Monday, March 23rd, 2026. Much to discuss as always, not least the continued conflict in the Middle East. Friday and over the weekend brought new headlines of potential escalation and de-escalation. We discussed the potentially stagflationary impulse from an extended oil supply concern, how central banks and rate markets are reacting, and, as if that wasn't enough, private credit concerns. Starting with stagflation, the duration and severity of the conflict and the targeting of energy infrastructure last week adds another layer of complexity to the energy picture. Our commodity team adjusts their base case higher and also assigns a 30% probability to a dire extended closure of the Straits, with Brent crude over $150 per barrel. This higher for longer energy regime brings stagflation worries. We broadly agree with Fed Chair Powell when he was asked about stagflation during the recent press conference. We're not at the levels of growth or inflation to bring to mind the stagflationary 70s, but we are seeing potentially a large stagflationary impulse. Borrowing from our global economist scenarios and my quant team's regime modeling, we look at how such a shock might feed through into asset classes. As you might expect, such an environment is negative for equities and bonds, but credit typically fares worst on a risk-adjusted basis. Given where the economy was prior to the conflict, scenario analysis suggests negative returns for equities and credit with little differentiation across regions, but low, slightly positive Sharpe ratios for bonds, with the winner being inflation-protected bonds delivering positive returns. This is more of a stagflation-like impulse. Full stagflation would mean much more negative returns across asset classes, with the havens potentially being the dollar, historically at least, price-based strategies such as trend following, or quality and defensive equities. There are some nuances according to our analysis depending on the central bank reaction. In stagflationary times, without financial conditions tightening, bonds perform meaningfully worse, equities a little better, and gold can act as an inflation hedge. Last week gave us a window into how central banks are thinking about the energy shock. Gianmarco, what did we learn?
Yeah, Alex, what a week for G10 central banks. The big question coming into last week was if and also how much central banks would respond to the current oil price shock and the prospects of higher inflation. Not so much in terms of imminent hikes, but more in terms of guidance for the rest of 2026. And in a way, you could say there are many analogies one could draw with the 2022 shock, for example. Obviously, at the time, COVID restrictions easing, inflation was already running higher. On top of that, we had big fiscal coming. Well, this time around, it's mostly an exogenous supply shock. So many were wondering whether central banks would sort of see through the shock, at least for now. And I think many hoping for that outcome were really left disappointed within, let's call it, the G3, US, UK, Europe. The case for the UK and the BOE was striking. I think that was the biggest shift in rhetoric that we saw. The BOE was expected to deliver another 2 cuts this year up until a few weeks ago pre-conflict. Instead, at the last meeting, we got a 9-0 vote split to hold versus expectation for 7-2. But more importantly, we saw some of the dovish members shifting from pushing for cuts to discussing hikes. For the euro area, the ECB struck a bit more of a balance tone, you could say. But the scenario analysis on higher oil, at least later, was strikingly hawkish. And also the headlines post-meeting sort of suggested that June is live as a meeting. The Fed, on the other hand, was the only G10 central bank where cuts were still expected up to last week. That changed, in part, obviously, because oil continued to rally, but also due to a more hawkish than expected FOMC. The pressure was focused much more on inflation rather than labor market, with the particular emphasis on goods inflation. So you could say generally the tone was quite hawkish across relative to expectations. Outside of G3, the central banks that relatively, and I would really stress here, relatively looked more likely to see through the shock were perhaps the BOC and the S&B. The BOC highlighted two-sided risks due to the weaker local economic fundamentals. With respect to the S&P, they cited downside growth implications from the conflict as the main risk to the economic outlook. And moreover, to us, they appeared to prefer the FX channel as a monetary policy tool. So overall, there was a good amount of divergence among central banks' reaction. And while oil for now, in our view, will likely continue to dictate the directionality of rates and yields, we think different central banks' rhetoric can probably dictate the magnitude of these moves and how much of this pricing eventually gets realized. Obviously bigger for those places where the rhetoric has already shifted hawkish.
And how does all this feed through into FX, Gianmarco?
Yeah, it's an interesting question because in many countries right now you have opposing drivers at play, right? You have obviously a commodities terms of trade shock, which is negative effects for the importers. But then you have yields moving higher in a lot of these countries, which without a commodities terms of trade shock are generally good for effects. So far we've showed that commodities have been the main driver for effects. And we also showed that in 2022, commodities continued to be the main driver, for example, for euro dollar for a good part of the year, regardless of what rates did. So we expect commodities to remain in the driver's seat for FX for now. But one thing to note on commodities terms of trade, and specifically for commodities effects against the dollar, so the likes of Aussie, NOK, is that historically we find that the cross-sectional correlation between moves in commodities effects against the dollar and changes in commodities terms of trade tend to be equities regime dependent. And what do I mean by that? As equities remain well behaved, measured in our analysis as the level VIX is at, the cross-sectional correlation between commodities effects and commodities terms of trade changes remains quite high. So let's say as energy commodities continue to rally, the exporters see their currency appreciate even against the dollar. But as the VIX moves higher, that correlation tends to weaken and can even turn negative, right? So that's a warning sign for the high beta commodities effects. If VIX spikes, you could see these currencies behave more in line with the risk off in equities rather than the rally in commodities.
Thanks, Gianmarco. And as if that wasn't enough to absorb, private credit has also been in the spotlight. Our high yield strategists make the point that private markets have absorbed software company exposures at a higher rate than either public loan or high yield markets. Our recent report shows that the higher software exposed investments have underperformed. But what does that mean for broader financial conditions? We would see three transmission channels. Via loan ETFs, which are a small part of the overall market, but given their daily liquidity, they can have an asymmetric effect on risk appetite and price discovery. CLO formation. CLOs are a large buyer of leveraged loans, therefore a slowdown in issuance could portend a tightening in financing conditions in those markets. And then finally, via bank lending, if such lending to the non-depository financial institutions was to moderate, it could also tighten financial conditions. So these transmissions are not necessarily in our base case. However, the investment grade credit market has not reflected those potential spillovers in our view and remains the most attractive downside hedge. So overall, we see a potentially stagflationary impulse rather than a stagflation regime. Functionally, this means slightly weaker equities and credit, with real rates performing better than nominals in bonds. Much will depend on their central bank reaction functions. A hawkish repricing is already underway, with inflation risks rising, but there's been some relative changes in rhetoric already. Private credit worries are centered on the large weight in software companies, but we're monitoring transition channels for potential spillovers into broader financial conditions. In such an environment, we think credit tends to offer a downside asymmetric hedge. Thank you for joining us today. This episode was recorded March 23rd, 2026, and I'm your host, Alex Saunders, standing in for Dirk Villa. For more details, Citi clients can check our report on the Citi Velocity portal. Next week's Research at Citi Markets edition will be hosted by Beata Mante, Citi's head of Global Equity Strategy. And be sure to watch our Research at Citi podcasts, which you can view on the same channel. The Macro Strategy team will be back in 2 weeks. Stay sharp.
This podcast contains thematic content and is not intended to be investment research, nor does it constitute financial, economic, legal, tax, or accounting advice. This podcast is provided for information purposes only and does not constitute an offer or solicitation to purchase or sell any financial instruments. The contents of this podcast are not based on your individual circumstances and should not be relied upon as an assessment of suitability for you of a particular product, security, or transaction. The information in this podcast is based on generally available information, and although obtained from sources believed by Citi to be reliable, its accuracy and completeness are not guaranteed. Past performance is not a guarantee or indication of future results. This podcast may not be copied or distributed, in whole or in part, without the express written consent of Citi. Copyright 2026 Citigroup Global Markets, Inc. Member SIPC. All rights reserved. Citi and Citi and Arc Design are trademarks and service marks of Citigroup Inc. or its affiliates and are used and registered throughout the world.